Today, deal structure day. The day that everyone has been waiting for.
Yes.
Okay. So, to sort of start us off, talked a little bit about this last time, but I want to reinforce a handful of concepts before we sort of get started. Obviously, get your laptops open and pull up the spreadsheet that I sent you a couple days ago, the deal structure spreadsheet. You've also got a handout in front of you with the printed out, and then also kind of a blank version that we'll get with a little bit later. So, as you're going to see today, and as we're going to talk about, deal structure is probably, once you've gotten to the point of figuring out you want to move forward with a project, we've got to sort of figure out, okay, we think the project is a good idea. We think, so that part is already sort of a done deal, so to speak. All right? And we figured out what the project is going to be supposedly giving us back in terms of a rate of return and that sort of thing. So now we're in the position of saying, okay, we're going to move forward with this thing. So we've got to figure out who is going to be part of this deal, how much each person or group is going to contribute. Based on that contribution, how much of a return are they going to receive? When are they going to receive it? Under what conditions are they going to receive it? And also, are we going to look at this on a before tax basis, an after tax basis? How is all of this going to kind of meld into sort of motivations for the developer, motivations for the investor? So those are the kinds of questions that you should be sort of constantly thinking about as it relates to sort of the deal structure. And as I mentioned last time, obviously, it's mission critical that you figure out what this deal structure is going to be prior to engaging in the project, because if you don't, you're probably going to have some unhappy campers, as you get into this, because you're going to have people with certain expectations of, why am I not getting, X rate of return whenever you told me that I was going to get this or that or the other thing, and so all of this needs to be kind of nailed down up front, okay, and agreed upon by everybody, and all of these kind of weird, quirky circumstances, for the most part, to sort of be worked out. Now, obviously, what we're going to be focusing on today are a couple of relatively straightforward types of deal structures, and what you're going to be asked to do ultimately is complicate these, okay? But right now we're going to start off with some relatively straightforward sort of deal structures and talk about the terminology and talk about kind of the assumptions that we've got to sort of make. Okay, now within this particular model that I built, you've got, I think it's 8 different assumptions. Okay, those are all in yellow, all right? Or on your sheet, sort of in gray. Now, a couple of them don't show up because they happen a little bit later down the page. But these are sort of the deal points, if you will, that for our deal structures here, that you've got to sort of come to an agreement on, okay? And be able to sort of take that information and then see how it all sort of flows through from there. So what we're going to do is we're just going to walk through this, sort of step by step, and then just try to explain the pieces, explain some of the computations, and then we'll kind of go from there. Okay, does that make sense, everybody?
Yes.
Okay. Now, with this particular deal structure, once again, you've got an actual physical handout. I'll go ahead and pull mine out so I can have it right in front of me as well. All right. Very straightforward. In this one, we have a project, $1 million project, that's what we're paying for it, and then we're making the assumption that 5 years later, we're going to sell it for $1,100,000. So $100,000 capital gain at the end of 5 years, okay? Very straightforward, yes? Okay. Then we come down here with a loan-to-value ratio of 65%. So that's just simply saying, okay, if we're borrowing 65%, then this first calculation that's done here is just simply taking, if you've got a maximum of 100%, you subtract out 65%, that leaves you with 35% as your equity. Okay, everybody cool with that? All right. Now, this next piece, I set up this way on purpose. Your interest rate on your debt is 5%. But for this deal structure and this analysis on purpose, I wanted to keep it as simple as possible. So this is an interest-only loan. Okay? So there's no basically principal payments. It's going to be interest only. Does everybody hear me on that? Yes or no? Okay? So whenever you're seeing your payments in terms of to the developer and to the investor, and you're looking at interest payments, that is strictly all it is. Interest payments only. Okay? Now, again, that leaves us with our equity percentage we said earlier, taking our 100% overall project, subtract out the loan to value of 65%, that gives us our equity percent of the 35%. Okay. At this point, absolutely nothing should be new to you. Okay? Now, here is where we begin to kind of start in with the first vestiges of the deal structure. Of the equity that we are putting into this deal, the 35% equity. Okay, first of all, how much is 35%? $350,000. Okay, so if we've got $1 million, whoops, okay, as the project, 35% equity, that's going to be $350,000 that is equity. Everybody cool with that? Yes? Okay, now then, of that equity, where is that equity coming from? In this case, what we're saying is we've got two different people within the deal structure. We've got a developer partner and we've got an investor partner. And we're sort of making the assumption that the developer partner, for the most part, is doing all the work. Okay? And the investor partner just contributing cash. All right? So in this case, the developer partner, we're saying they're putting up 20% of the equity, and the investor partner is putting up the remaining 80%. Okay? So what that means, if we start out with the developer partner, they're putting up, okay, I'm not going to trust anybody, including myself.
35.
Okay.
It is something.
All right. $70,000 is coming from the developer. All right. Then of the $350,000 equity, the remaining 80% is coming from the investor. Okay, so 350,000 times 80%. So $280,000 is coming from the investor. Okay? Everybody kosher with that? Okay. So that gets us, scroll up here just a little bit. All right. So once again, our developer's putting in 20%, which is $70,000. Our investor is putting in 80%, which is $280,000. Okay, so we're going to just kind of, for the moment, just set those numbers to the side and not really concern ourselves with them. We're going to kind of continue on with some of the other assumptions about the project. Okay, so the next assumption that we've got to state is how much annual net operating income is this project generating, okay? So this is going to, obviously you know how to get to NOI, in terms of taking your income, subtracting out vacancies and collection losses, subtracting out operating expenses, and eventually you get down to the project annual NOI. So whatever that is, we're going to pop that in. Well, that's an assumption that we've obviously, I've either got to give you or you've got to figure out based on other criteria that I provide you. All right, so 75,000 is that NOI. From that, we've got to subtract out the project annual debt service. Okay, now if you remember what I said early on, this is an interest-only loan. Okay, so the debt service is strictly going to be the interest expense. All right, so if we kind of go back up here for a second, think about how you would calculate that. I mean, now granted, obviously you can cheat and look at what the formula was, but just think about how you would go about calculating that. All right? Take the project purchase price of $1 million, multiply it by 0.65 to get the total debt, which is going to be $650,000. Yes? Okay. Then take that number and multiply it by the interest rate on that debt, 5%, and that should give us the $32,500. Does that make sense, everybody? Yes or no?
Yes.
Okay. So
That's the annual debt service?
That's the annual debt service. It's interest expense only, simply because that's the way we set up this particular deal structure that's an interest-only loan. And the only reason I did that was for simplicity, so that you could have the transparency to kind of see what's really going on without mucking it up with a bunch of additional calculations for the moment. Because the real lesson that I want you to walk away with this is to understand the deal structure piece of it. We can go in and we can complicate it up with the other pieces, which you're going to do, but for the purposes of what we're trying to get across today in terms of the educational piece, I just want you to understand the deal structure part. Okay. So obviously once we've put in our NOI, we've subtracted out our annual debt service, that gives us the before tax cash flow. Okay, for our purposes, this is a number that we're going to be playing with regard to distributions to our developer and our investor, okay, on an annual basis. Or does that make sense? Okay, that $42,500. Okay, now, this is the first thing that people should have a real serious question about, or not really serious question, but just a question about, what does this term pari passu mean?
What you put in is what you get out.
Yeah, basically it's a sort of a proportional thing of, if you're putting in 20% of the cash, you should be getting 20% of the return, okay? Now, don't get hung up on the term, okay? I mean, it's just a term. You'll hear folks talk about it and they'll say, okay, we're going to do a pari passu distribution, and the first time you ever hear that, you're like, what the hell are you talking about, okay? Don't get hung up on it. All it is what Jarvis said. What you're putting into it percentage-wise is what you're getting out of it percentage-wise, okay? All right, so if that's the case, then with regard to our before-tax cash flow of $42,500, if we're doing a pari passu distribution of that on an annual basis, then what we're saying is that 42,000. Some of this. All right, that 42,500 before tax cash flow. What we're saying is that 20% of that is going to go to the developer partner, which is going to be what we've got up there, $8,500. All right, did you see that? Yes or no? Okay? Now, just so that you know, just make sure that I'm clear, you probably should be taking notes on this, because the quiz is going to be closed computer.
Oh.
Yeah, no, that's why, I mean, I'm looking around, I'm seeing some of you just sort of staring, you know, you probably should be taking notes on this. Okay, so 8,500 is how much is going to the developer. All right, now, to the investor, the 42,500 before tax cash flow, they are going to be receiving 80% of that. All right, which, do the math, we should get 34,000 as the investor portion of the distribution on the before tax cash flow. All right, does that make sense? So all we're saying, that pari passu distribution is strictly based on what their percentage that they put in terms of the equity. Okay, does that make sense? Now, I'm just going to change this just so you can kind of see what I'm talking about. If I go up here just to that one item, and I were to change that to, let's say, 100% for the developer. Okay, well, if they put in 100% of the money, then they should get 100% of, in essence, the before tax cash flow. Thus is what happens. Okay, and then obviously the investor would get nothing since they put in nothing. Okay, and then vice versa would be true. You know, if we put in 0% as the developer, then that means the investor puts in everything, then they get all of the cash flow. Everybody cool with that? And if we made it, excuse me, 50-50, oops. Skip down over there. Okay, if we make it 50-50, then, once again, equal split. Okay, is everybody cool with that? All right, so let's go back to the way it was. 20%. Okay. All right. Now we get into the sales proceeds portion. Okay, in terms of who gets what and how much they get as it relates to the sales proceeds. Okay, so first of all, in this particular case, hopefully this is, all right. So first of all, let's take and let's add up these two. And what do we get? Okay. So when we take the distribution, we're working backwards here just for a second to sort of illustrate this. So if we take the 360, or the 90,000 plus the 360, which is the proceeds from the sale, we get $450,000 from the proceeds from the sale, total. Okay, now here's where I want to test your logic. Where is that $450,000 coming from?
On the sale.
Yes, it's coming from the sale, but how are we getting the 450?
Down payment and
Okay, subtract out your down payment or your equity,
yeah, capital.
Less than profit.
and then you're left with your $100,000 capital gain. Does everybody see that? Yes or no? Okay, because in other words, we bought the property for $1 million, but we sold it for $1.1 million. Okay, or $100,000 capital gain. Does that make sense, everybody? Yes or no? Okay, so that's where that number, or those two numbers, are coming from. All right, this is simply taking basically the total amount that both partners are going to receive, subtracting out the equity that they combined, put in to get the capital gain, okay? All right, make sense? Any questions? Okay, moving forward. Okay, so let's focus now on the pari passu portion of this analysis. All right, so what we start with is basically, let's kind of go to the far right here for a second and look at the overall project. Without separating out or without dealing with deal structure, just look at the overall project, okay? How much total equity is being put in? 350,000. Okay? How much total before tax cash flow is being generated by the project? 142,500. Okay? Now, in the final year, year 5, you get the total cash flow from the operations plus the reversion. Okay, so in this case, you're going to have the 42,500 plus the 450,000. Does everybody see that?
Technically speaking, the term reversion applies specifically to that money, the 450, or is it just another word for the sale as a sale? I just want to be...
Reversion just simply means that what you sort of put in, you're getting back out. It's reverting back to you.
Right.
Okay? Sales proceeds, it can be kind of messy because you can sort of say, okay, the before-tax sales proceeds, the after-tax proceeds, you know, and what you sort of include in that. In this particular problem, in this particular circumstance, we are strictly looking at it on a before-tax basis, just so that we can illustrate the concept.
Okay.
Okay? Now, so does everybody understand now where this set of cash flows comes from? Okay? Everybody good? Okay. So, all you would do is put in that set of cash flows in your calculator and then solve for internal rate of return. Very simple. Okay? Are we good with that? Anybody have any questions on that? Okay. Now, what we've got to do is extract from that what dollar amounts are going to be going to or coming from the developer and what dollar amounts are going to be coming from and going to the investor. Once again, this is pari passu, so it is strictly based upon their percentage contributions. Okay? So in the case of the developer, 70,000 was their initial equity. We want to put that back up here just to make sure that everyone should have written it down, just in case you didn't. So of the original 350,000, if we take and we say the developer is putting in 20% of that, then that represents the developer's equity. Okay? So that's where the 70,000 comes from in column 1 there, or well, this column here. Okay? Everybody kosher with that? All right, now, the 8,500 is simply the split that they get off of the before-tax cash flow. They get 20% of that. So that's where the 8,500 comes from for the developer. Okay? Everybody cool with that? Okay? Now, the year 5 cash flow plus the reversion, all right? So there, what we've got to do is we've got to say, all right, the total reversion is 450,000. The developer is going to get 20% of that, or 90,000. okay? But in addition to the 90,000, they're also going to get 8,500 from the before tax cash flow for year 5. So you're simply going to add in the 8,500 before tax cash flow for year 5. Okay? Does any bit of that not make any sense to you? Should be pretty straightforward. Okay? Now, what you could do is, obviously, whatever's left over, quite frankly, if you just were to take the total project, subtract out the developer piece, whatever's left over is going to be the investor's piece. Or, if you want to go through step by step, it's going to be the same process, except that instead of their contribution being 20%, it's going to be 80%. Okay, so they're going to have 280,000 as the investor's equity. Okay, and then for their purposes of the reversion, so 450,000 times 80%, so 360 is going to come from the investor's portion of the reversion. Okay, and then the before tax cash flow is based on basically the 42,500 times the 80%, giving us the 34,000. Or the total of 394,000. Okay? Everybody good with that? Now, yep.
Sorry, but I don't understand the 450,000.
Okay. The 450,000, if you remember, that was our total reversion. That we said that, in other words, we put in $350,000 equity, plus we got 100,000 as a capital gain. So those two added together is 450,000. That's our total reversion. That's the total amount we're getting back from the sale. Okay? All right. Now, what you're going to see with the pari passu, look at the rates of return. They're all the same. Okay? They're all the same because, once again, proportionally, everybody put in the same thing. Proportionally, everybody got back out the same thing. Okay? Now, let's just start with this for a second. Why might you, motivationally, as a developer and investor, choose to do the pari passu?
You're new in the game, so to attract money.
Okay? Anybody else?
The fairest.
I'm sorry?
It's the fairest of all the deals. Money in, money out.
Yeah, you say it's fair. It's fair based upon just the money contributions.
Right.
But what about the workload?
Yeah. The workload, that's what management fees are for. So.
Okay, well, okay, that's a good point. You could have worked in sort of management or oversight fees or developer fees into the operating expenses. Okay, separate and apart from the deal. Okay, so that's a good point. Okay, all right. What other motivations might we have here to do a pari passu?
To align the financial interests of both the developer and the investor.
Okay,
So
so
that
they both have the same
developer has some
motivations.
skin in the game.
Okay, they both have skin in the game. They're both effectively equally motivated because they're both going to get basically the same sort of returns. So if the project does really well on cash flows, they're both going to do well. If it does really well on the sale, they're both going to do really well. But, what happens, obviously, if it doesn't do so well on the cash flows, and maybe it does do well on the sale, does that really change anything? Well, as you say, their sort of motivations are aligned.
Right.
So in this case, it really doesn't make a difference. I mean, it's a sort of thing that they're perfectly aligned.
Right.
Okay, so that's a good motivation. All right. Now, we've already sort of hinted at, why would you not want to do a pari passu distribution?
It's responsibility.
Responsibilities, okay? That's the number one reason, okay? Is because if we have the situation of where you have the developer that's literally doing all of the work, okay? They are hiring all the contractors, they're dealing with the local government, they're the ones, you know, obtaining the actual bank financing, they're the ones, you know, dealing with the day-to-day sort of management oversight of operations, they're taking care of getting tenants, you know, pre-leased, they're dealing with all of that sort of stuff, and the investor is maybe doing nothing other than simply providing capital. And that's a quite common circumstance, you know, where you do have that sort of situation. You have the investor that literally is, you know, maybe not even in this country, you know, just simply saying, here's a big pile of cash, go take care of this for me, leave me alone, send me a check, okay? So, under that sort of circumstance, we've got to come up with a different type of deal structure, okay? And we've got to figure out how that sort of deal structure might be put together. So before we leave the pari passu, are there any questions up at this point about any of this? Okay, final last call. Yes?
Just to be sure, the preferred return to investor there that you have on line 34, that's not part of the pari passu.
No, it is
Okay,
not.
good.
That
All right.
is, everything is sequential.
Okay.
Okay. All right. Moving forward. Okay. So get the tissues out so you can start crying. All right. Now, what we've got to do is take a look at a couple of different options as it sort of relates to how this may be set up. Now, this one I set up purposely to be a bit wacky and to kind of explain what's sort of going on here. All right, but so before we kind of, well, we wouldn't get into it, what the heck. So in this one, if you actually look at the cash flows here, look at what's happening. Is there anything, anybody see anything wacky about that?
Oh, he's losing money.
Yeah, the developer is actually having to contribute money, more money into the project, okay? Now, I'm not saying that's realistic. That's not my point. I did it on purpose to sort of illustrate kind of what potentially could happen in some cases, that you could have a negative distribution that you know, have to obviously provide.
So would that 8,100 go towards what the investor is making? Is that what you're saying? Or it goes
Yes.
to somewhere else in the
No,
project?
it's going to the investor.
Ah, okay. So it's like, hey, I didn't make up for the, I have.
You did not give the investor what they
Want it.
wanted. And so you have to come out of pocket to be able to provide them with what they want.
Gotcha.
Okay? They are demanding basically more annual operating cash flow than what you're actually generating. Okay? If the project is generating $42,500 of before tax cash flow, that's the only cash the project has to distribute. Yes?
Right.
So if you're promising this investor, for whatever reasons, which we're going to get into here in a minute, that they're going to receive $50,600 a year, that difference of $8,100 has to come from somewhere, and in this case, we're simply saying it is coming from the developer. Okay? Does it make sense?
Yeah, because, well, pari passu, developer is liable for everything. Pretty
Right,
much
well-
for everything. You can look at it that way, where the investor is.
Yeah, but then it's about equal contributions, equal returns.
Right.
Okay, now, so this is where this very first line is part of what does the damage here. Read it. Preferred return to investor partner. Okay? What does it imply to you? Preferred return. That means they get paid first.
Right.
Okay? And so let's just take a look here. And let's just do it this way.
How does this section, how is it called?
It's just it's not really called anything other than it's just an additional variation of the deal structure.
Okay.
It's just non-pari passu.
Right. No, but I mean, we have clawbacks and, you know, all these
Yeah,
new
yeah.
names.
This one is just, it's just another variation of part of my point with this, well, yeah, you can simply call it, here's an example of a preferred distribution, okay? But part of my point with this is, and what you're gonna be doing, what you're gonna be seeing with this, is there are literally no limits to how a deal can be structured. It's all about what you can come to an agreement with your developer partner, or your investor partner, whoever, you know, they are, and however many of them there are. And what I'm simply proposing are a couple of relatively basic sort of deal structures to get, to a certain extent, your juices flowing in terms of thinking about how might I then create something that gives me what I want as a developer, but also gives the investor what they want, and you know, maybe pays each one differently at different points in time. You know, so there's a, I think you'll begin to understand as we kind of get a little bit deeper.
Okay.
All right, so let's do this. Oops. Okay. So, all right. So first of all, I want to kind of start, I want to play around with this, okay, just a little bit on the screen so you can kind of see what's going to happen as I tinker around with the numbers a little bit. All right. So first of all, the one thing that you will notice, in fact, I'm just going to make this 0 as well, as we're off that. All right. So let's say I have both of those set at 0. The one thing that you will take note of in this particular instance is that the equity provided by the developer and the investor has not changed. That is going to be held constant because that is what they put in at the very beginning. Okay, so I follow that. But my point is, now, even though that's what they put in as their initial equity, does not mean that's what they're going to get out of it with regard to the distributions of the cash flows. Okay, that is what is mission critical to understand. Okay, they may have put in 20% of the equity, 80% of the equity, but what they receive now is going to be determined by basically these two variables here. Okay, this preferred return and the leftover distributions. Okay, so let's start just for a moment without the preferred return, and let's just focus on the distributions. Okay, so what we're saying is that in this particular instance, there's going to be a 0% leftover distribution to the investor, meaning they're not going to get a dime out of whatever the revenues are for the project. Does that make sense? Everybody clear with that? All right. Now, also, if you sort of take a look with that, let's change one little thing. Let's make this 100%. Notice what also changes. Year 5 and reversion. Okay, just look. Okay? You can do it on your own screen just to sort of see what I'm doing here. But let me just point this out. Okay? If we give all the leftover distributions to the investor, 100% of what's left over, they're getting not only, once again, all of the before-tax cash flow, but what else are they getting?
All the reversion.
They're getting all of the reversion above and beyond the reversion of the dollar amount that the developer originally put in. So in other words, the developer, in this case, they're going to get back their original $70,000, but they're not getting anything else. Does that make sense? So in this case, horrible situation for the developer. They put 70 grand in, they get absolutely no operating cash flows, and they get no reversion, other than the 70,000 they originally put in. Okay? Now, we flip it. Same thing, but now for the investor. The investor is only getting back what they originally put in. All of the cash flows and the proportion, or basically all of the extra reversion, all of the capital gain is going to
developer.
So does,
in this particular deal structure. But see, it doesn't have to be set up that way. But that's the way I've set this one up. Okay? So whatever's left over is going to, so let's just do this, make it 50-50. Okay, if we make it 50-50, now what we're basically saying that even though, let's just make sure this is clear in your head, even though as a developer you're only contributing 20% of the equity, you're actually getting back 50% of the cash flow and 50% of the capital gain. Does that make sense? Yes or no? Okay, so this is where, you know, what we were sort of talking about that begins to kind of make sense. Well, now, obviously, look at what that does to the developer's return. Gives a return to the developer, you know, a nice 37% return, but an only a 10% or 10.5% return to the investor. Well, now, if your investor is willing to accept 10.5%, you're done, so to speak, okay? Because you're probably going to be thrilled as the developer with your 37.2. Now, keep in mind, the overall project is only yielding 16.7. And the reason why you're able to get this inflated return is because you're basically siphoning off part of the return under pari passu that would have gone to the investor. Does that make sense? Yes or no?
Yes.
Okay? So,
And you also put in less as the original investment.
that's what I mean. Yes.
so does leftover distribution, does it always apply to cash flows and
Does-
proceeds?
it does, we can separate it out.
Okay.
In this particular example, I lumped it all together to keep it simple. Okay? Now, what if I put in 20% here? Or, in this case, actually, let's, sorry, just the opposite. There we go. All right. So I put in 80% to the investor, then the 20% to the developer. What do we have all of a sudden? We have a pari passu. Does everybody follow that? So all we're doing with that particular input is basically just simply changing out what those distributions are going to be from one year to the next. Okay, everybody cool with that? Yes or no? Okay. Now, okay, let me see the best way to probably get at this. Okay, this is probably going to be the best way to get at it. All right. So let's just sort of start off where right now we're simply saying we are giving a 0% preferred return and we're giving 0% of the distributions to the investor, okay? But yet we actually want to give them something greater than that 0% return. We want to give them a preferred return where they get paid first a set percentage. We can set whatever that percentage is. So in this case, we're going to set that percentage as 10%. So now watch what happens. First of all, you're going to say, wait a second, where's that $28,000 coming from? Well, it's a percentage of their original investment. Okay? That's why I did it as 10%. All you're really doing is you're saying the investor put in 280 grand up front, and we are going to give them a 10% rate of return,
No matter what.
no matter what, each year on that 280 grand. So that's going to be a minimum of 28 grand a year. Okay? Does everybody follow that? Yes or no?
And then you can do the 80-20 or 20-80 or whatever.
Right.
Yeah.
Okay? After that. All right? So does everybody understand where that comes from?
Yes.
Okay? So just to sort of do another one, let's say we give them 20%. Okay? Now all of a sudden the developer's in the negative because we really can't give them that high of a return. Okay? All right, so let's go back down to 10 here for a second. All right? So now, if we come in and we do the leftover distribution, before we do that, all right, so you look, this is the maximum amount we have to pay out, okay? So that means that now any percent that I put in here is leftover distribution goes to the investor, all right, that's gonna come out of this column right here.
So it's gonna be like 20 or 80% of the 42,500, right?
Well, no, it's gonna be of this amount. In other words, like, let's just say 5%, okay? That is gonna be coming out of basically what the developer had. So as you continue to sort of increase that, let's just say we make it, they get everything. And see, the interesting thing is if they get everything, then this preferred return is basically irrelevant.
Right.
Okay, or at least up to a certain point. Now, if you were to, I don't know, jack it up to 25%, well, still, okay, it's basically saying in that case the developer has no money to pay, so there's not going to be anything. All right? All right, so we go back down, let's do 50-50. Okay, so,
But what was the number, 100?
okay,
Yeah.
this is, like I said, this is the part where you're going to have to, let me erase this and we're going to do it by hand so you can see precisely what is happening. Okay, in terms of the logic and the math. Okay, so we started with 42,500 as before tax cash flow that is available for distribution. Okay, now then, of that, and let me go back to this just for a second. Of that, 28,000 got paid out as a 10% pref to the investor. Okay, that leaves us with 14,500. Okay, so that's how the math is going to start. Now, if we go back up here and we're saying, okay, we're going to do a 50-50 split after that, then what you're basically saying is take this number, divide it by 2, okay, or multiply it by 0.5, however it makes better sense for you. Multiply it by 0.5 and you're going to get 7250 that's going to go to basically the investor, and you're going to get the remaining 7250 that's going to go to the developer. Does that make sense, everybody? Yes or no?
Mm-hmm.
Okay. So now what that means is in the investor column, the reason why it's 35,250 is because you're simply adding together the 28,000 with the 7250. So it's just the order of the operations to try to you know, in terms of the math, to kind of, the key to thinking about it is the preferential gets paid first. That drives everything from that point forward. Okay? Everybody cool? Okay. So, let's change the distribution to the investor as being 80%. Okay? So now, what that means is if we change that to an 80% distribution, then 14,500 times 0.8 would be 11,600 to the investor, and then the remaining 2,900 would go to the developer. So obviously, in order to get the 39,600, all you're doing is just adding those two together again. Okay. All right. So now let's spend a little time just talking about kind of some of the mechanics of this. First of all, what do you think about it? Just in terms of you know, the logic behind kind of this deal structure thing?
I don't know.
You don't like it?
I mean, no, but it helps put the investor's mind at ease a little bit, knowing that they have something.
Well, in terms of what return they're gonna be potentially getting?
Right.
And when they're gonna, okay,
Yeah, well, I was gonna say, turn on their capital. Right?
okay.
You can set a hurdle rate with this, so if somebody comes to you with a rate that they want, it lets you provide that.
And you could back into it. You know, in essence, you sort of back, you play around with it, like, if, you know, they sort of say, okay, yeah, every year I wanna get back 10%, that's my preferred return, but then I want a specific hurdle rate, or, you know, maybe for the investor, I want my hurdle rate to be 15%. Well, in order to do that, start playing around. So probably around 47%-ish. Yeah, 47.5 probably. I mean, just, you play high-low, but eventually you could get it to the point of where, all right, we're gonna be able to give them their 15%, you know, rate of return, and then we're gonna get to keep everything that's left over, okay? And that is, believe it or not, that's a quite common sort of deal structure, is where your money partner is just simply saying, look, I don't really care about all of this, but what I want is pretty much on an annualized basis, I want a fixed
10%.
percentage rate of return, much like you're gonna be paying back a lender, a fixed percentage rate of
Guaranteed
return.
10%.
Yeah.
Guaranteed 10% and 15 on the project. You know, they.
Okay. All right. Now,
Dr. Corey, so do you kind of see like these different distributions like based off of like the business structure? Like does it kind of go like, so like for joint ventures, let's say if you have like an equity person and then you have like a GC, they come together and they do a venture, you probably see a pari passu or something like that?
well, I mean, it depends, because like, you know, a general contractor may not be a part of the deal structure at all. I mean, they could be. But the general contractor, if their only role is just the actual construction piece, they're not, because there's a difference between a developer and a general contractor.
Right.
You know, a developer is the person, or, you know, that's basically putting everything together. And so the GC could be a totally separate, independent, you know, party from all of this. Now, you may want to incentivize your general contractor by giving them some sort of, like if they finish the project, you know, under budget and before, you know, the sort of the deadline, then you give them some sort of a bonus or, you know, something like that. But you could, I'm not saying you don't or can't, you could give them a piece of the structure, the deal structure that, you know, and what might be common would be to sort of say, okay, it doesn't really make sense to give the GC a piece of the operating cash flow, but what may make sense is to give them a piece of the reversion.
So maybe I asked that wrong. So I'm just saying like if the GC was going to play like an investor part also and didn't put capital in there. So the real question was like based off of that expertise,
Right.
you know, coming to the table, do you see like how the deal structure?
Well, yeah, no, I mean, okay, in a perfect world, everyone is going to be compensated what they should be compensated based on their skill sets and what they're actually delivering, in a perfect world.
Mm-hmm.
We don't live in a perfect world, okay? And so the deal structures that are going to take place in some cases are going to be completely lopsided, you know, one direction or the other, you know, depending on who just maybe happens to be able to do a better job of negotiating or a better job of understanding what they're putting together up front. You know, once again, some of these money partners are very unsophisticated, you know, and they are just simply saying, I want a simple return. You know, they can only do simple math, okay? And I'm not trying to be, I'm being a little bit facetious, but to a certain extent, they simply are saying, give me my 10% a year. That's all I want. That's all I need. That's all I care about, okay? And, you know, you as the developer are just trying to back into, okay, how can I give them that 10% and then I potentially take on everything else. But then you could also have a very sophisticated money partner, which is also a lot of times the case, that, you know, those folks part of the reason they are a money partner is because they are sophisticated. And they're saying, you know, what is the most that we can possibly extract from this deal, but yet still, you know, give the developer enough to live off on and, you know, survive. But we're not going to give them, you know, any more than we absolutely possibly have to. And so all I'm saying is, you know, there's no absolute, you know, there's no perfect situation and scenario as it relates to this. I mean, you can try to get, you know, to a point of where everyone is reasonably content with what they're receiving, but, you know, inherent in our nature, we're all greedy, you know, and we're all searching for what is the maximum return that we can get. And at the end of the day, you know, hopefully you can navigate that by, you know, having a deal structure that everybody is comfortable with. Okay?
We did 3 or 4 deals with a hedge fund from New York, York Capital, and this is exactly the way it was structured. However, at the end, after we did all the work, if they didn't get their preferred interest, guess what you got? 0. So but that's exactly the way the deal was structured.
Okay? Now, everybody comfortable, confident with what we're doing there? You think so?
You think so? You think quiz.
Okay. Now, okay, go ahead.
So when you were talking about trying to back into hurdle rates, when you had it set up originally, the investor internal rate of return was around 16, and you were backing down to 15. So here's my thought on that. If you set that at 47.5% to get to the 15%, it's based on that cash flow being 42.5. Because you're not leaving any wiggle room. So if you don't make that, you're really hurting yourself. So wouldn't it be better to kind of say, look,
Okay.
I'll do this, but
You're launching me right into my next topic.
okay,
Okay, so think about it like this. Would you, as the developer or the investor, either one, both in tandem, would you prefer to have a reliance on the operating cash flow as your return, or would you prefer to have a reliance on the capital gain? You know, and what I mean by that is because, to a certain extent, if you're the developer and you're in control of the day-to-day operations of this property for the first 5 years of operation, if you haven't turned it over to a separate, you know, management company, you can manipulate the heck out of that before-tax cash flow. Yes?
Right, yeah.
In other words, what I mean by that is, you can all of a sudden start basically overburdening that before-tax cash flow with extra, maybe unneeded expenses. You follow me? Okay? But that's not necessarily all bad. I mean, it is if it's unneeded expenses. Here's what I'm trying to get at. Fundamentally, a property is going to return a rate of return to an investor based on one of two things, or the combined two things. It's going to be off the operating cash flow, or it's going to be off the reversion. Pure and simple. Now, let me do this. We kind of...
Before you move too much forward, can you go back to doing the 80-20 and just explain how we're, because my numbers on paper don't match what the numbers are on
on which part?
on the distribution.
Right here?
Yeah, leftover to investor 80-20.
Okay.
Because the math that you did on the board, you get 11,600 plus the 28,000. It's 39,600, but then we get a different number on the.
Hold on. Okay. So let's put this at 0, and then put this at 20 or 80%. Okay. So what are we saying is different?
If you add the 28,000 right there on your example on the board, 28,000 plus the 11,600, it's 39.
But you have to have
That's the
10%
8%
too. You have to have the 10% up top.
You have the
too.
10% on top.
The
The
preferred.
preferred has to be 10.
That's what he's trying to say, I think.
Okay.
That's the number he's having an issue with.
Okay. So I guess I'm confused what you're having.
Behind you. On the board, on the board.
Okay,
28,000 plus 11.6. 39.6.
Okay. I found my mistake.
okay,
That's
okay,
it.
all right.
That's all.
Okay, so,
Thank you.
Moving forward.
I was on board. Okay. So let's do it this way.
How do you call this section?
Still not non-reviewed. Posse.
Refer to slash other.
Look back.
No,
IR, look back.
we'll call it slumlord analysis.
What about you?
Okay. So, what we're trying to kind of illustrate here is, let's say that we've got one project where we've got $100,000 cash outflow at time period 0. And this is approaching it one way. We're going to approach the project one way is type A versus type B. Okay? Now the cash flows that we receive from this project in terms of our before tax cash flows or our net operating income off of the project, let's say for this property it's going to be $30,000 a year. Okay. And over here, it's going to be $20,000 a year. Okay. And then our reversion for this one is, let's say, is going to be 100,000, and for this one is going to be 150,000. Okay. In terms of cash in, cash out, identical. Yes.
Cash
Okay.
in, cash out.
In other words, okay, you've got $150,000 of operating cash flow here, plus $100,000 in the sale. Okay, here you've got $100,000 of cash flow plus $150,000. So total revenue received in both instances
Okay.
is the same. Okay.
They're received differently at different times.
Yeah.
Yes, the same amount. So this one, we are in essence depending on the operating cash flow to deliver our return. In this one, we are depending on basically the sale. Now, the reason I call it sort of the slumlord analysis is, which one of these two would you argue is the slumlord? A. Because they're milking the property for every dollar they can, generating as much cash flow right here, right now, foregoing the future reversion, okay? Their concern is about getting as much money as they can right here, right now, okay? So if we do just the analysis of this, just in terms of a simple internal rate of return, okay? This one we get a 30% rate of return. Okay? this one. So who wins? Slumlord. Okay? Now, of course I purposely set it up that way. Now, here's what we're trying to illustrate with this, and this gets back to part of what we were dealing with the deal structure thing is, if I can control the property and I can control the operating expenses, then what I'm doing over here as a slumlord is I'm basically saying, I am not spending any money on anything, so therefore my net operating income or my before tax cash flow is as high as possible. Does that make sense? So I am probably foregoing deferred maintenance, or I'm not foregoing deferred maintenance, I'm actually incurring deferred maintenance in the sense that I'm not fixing things that probably should be fixed. I'm not replacing things that probably should be replaced. Okay? Well, while that gives me a lot of potentially operating cash flow right now, it probably has a negative effect on the reversion because whoever buys it 5 years from now is probably going to have to incur a lot of those costs to obviously bring the property up to a standard of where it's going to be continually able to be operated. Does that make sense? Mm-hmm. Now, purposely, this is obviously a nice little academic example and it's meant to just simply illustrate the concept, okay? But in practice, this is, potentially the reality, but the part that we don't know sometimes the answer to is what is that reversion going to be? We try to predict what that reversion is going to be, but we don't really know 5 years from now what we're going to be able to sell that property for unless we've got somebody waiting in the wings that has initiated a contract and said, yeah, we're going to pay you $150,000 for this 5 years from now. The likelihood of that is pretty much almost zero, okay? So that's where you sort of take on the risk. Thus, kind of tends to lean a lot of owners and investors in property to gravitate toward this model simply because this is the more certain model. You get the cash flow now, as opposed to potentially invest by meaning, keep it well maintained and maybe even over the top well maintained with the hope, and that's really the only word I can really use, with the hope that that's going to be reflected in that reversion price, 5 years from now, okay? Now keep in mind, this is just making the assumption that the market today is basically the same as the market tomorrow. A lot of stuff can change over 5 years. Interest rates can go up, interest rates can go down. They're not probably going to go down, they're probably going to go up. But the point being is, you're going to have a change, just, if nothing else, just in interest rates. You're also going to have a change in what is the demand for this product 5 years from now in terms of how much competition has been built similar to this product over the past 5 years, okay? You're going to have, other, you just sort of think about what are all the other issues that could pop up. You could have a radical increase in property taxes or insurance costs. You could, there's so many different things that could happen over a 5-year term to basically change, what this reversion might be. That once again, a lot of folks really want to try to lock in. Now, probably the practical thing to do, the normal thing to do, is probably to split the difference. Is to sort of say, okay, we've got to keep the property maintained. We can't not, replace the roof. We can't not, mow the grass and keep it, keep the landscaping in decent condition and so forth, so on. And, so then we're probably somewhere between these two in terms of the extremes, as a rational, reasonable sort of operator. But yet, I'm sure everyone can probably give examples of people and properties they've seen that probably do tend to operate on the fringes of both directions. Because obviously with super high-end properties, you're pretty much obligated to obviously keep those properties maintained at that Class A sort of level, or you're going to lose all your tenants. Or you may be legally required to provide all those services, or you're going to lose your tenants, and not only lose your tenants, but probably be, sued. Okay, anybody else want to add, or,
Is there some, do you have an idea, or is there some type of strategy where I saw like doing a lot of community outreach in certain areas where the landlord would, you know, potentially cash flow the property, but then in the end, they would foreclose on the property, or let the property go on foreclosure? Is there like any type of reason behind it besides?
okay,
they just-
I'm not sure I followed what you just said. Okay, you said, okay, who does what, who does?
So like a landlord would come in and let's say they would buy a property for like 100,000.
Okay,
They would rent it out for probably like, I don't know, probably like a couple years or so, and then like probably like in the 2 years, you would see like the property would be basically foreclosed on.
well, but, I
Or,
mean,
and is it because of just lack of funds, or is there a strategy?
No,
I wouldn't think there would be a strategy behind
I'm just
that.
asking, like, are they giving it to it to cash flow
I mean,
and
you
get
know,
out?
no,
or-
There-
no, you're destroying your credit.
Because a lot of the tax laws have been written, you know, to where it precludes like passive losses, but yet, you know, active losses, you know, they can use it as a tax write-off, but I wouldn't expect that anyone inherently would do that. But
Wouldn't this cash flow, if you're the operator, couldn't you manipulate that to most benefit you in the deal structure?
yes, that was where I was going with this, okay? We got a little bit detoured on this, but the whole point behind what I'm putting up here was to say that you have, as the potentially the developer, owner, investor, whoever's in control, potentially has the ability to manipulate this cash flow, okay? Now, the sale, you know, that may be a little bit of a different thing, because there, you kind of, okay, you're putting it out to market, you've got multiple appraisals, independent appraisals that have been done on the property, and, you know, hopefully, but even that value, to a certain extent, can be manipulated, because what are most investors paying for? They're paying for cash flow. The higher the cash flow the property is generating, theoretically, the more they're going to pay for it. Well, now, if that's true, then this model sort of falls apart. Because if that's the case, then you think that an investor is going to pay a lot more for this property than they would for this property. Well, if they're purely basing it on the historical cash flow. But what we're sort of making the assumption here is the market is a fairly efficient market with regard to investors being able to kind of ferret out that type of information and be able to sort of look through and look into the books and sort of say, this guy is basically running this as a slumlord. He's not doing the things that need to be done to maintain the property. That's the reason the cash flow is so high. And it's got a lot of deferred maintenance. So therefore, I shouldn't pay as much. But if you have an unsophisticated buyer, which there are a fair number of unsophisticated buyers out there, and they're simply looking at, oh, I'm all excited, $30,000 cash flow, and they're thinking, okay, I'm going to come in and I'm going to continue to get that $30,000 cash flow forever without having to do anything to the property. They've got another thing coming, you know, in terms of the reality. So, you know, because there could also be the situation of where you have an investor looking at this one, and, you know, they could say, well, based on that cash flow, I'm not willing to pay that much. I may be only willing to pay $100,000 because that's a miserable cash flow. But they're also, they may be thinking in the back of their mind, the reason it's a miserable cash flow is because they're not doing a good job. They're overspending on a number of things, and I can reposition maybe this property and get higher rents and possibly slash some of those operating expenses and get the cash flow up, so my $100,000 investment could actually be, you know, worth that much more. Okay.
I was just gonna say a lot of it would probably depend on the lending terms that you get too. Like, I mean, they might not even be able to qualify for something, let's say, for $150,000. So, I mean, that would affect it too, depending on how the market is as far as lending.
Sure. No, absolutely. Okay. So, final point, getting this back to the deal structure sort of conversation. The whole reason for putting this up there and to sort of talk about this is that you have to think about who has control, operating control, over the property during the holding period of the deal structure. Does that make sense? Because whoever has control, if it's not an independent third party, if it's the developer or it's the investor, then to what extent all of this can be manipulated, including, to a certain extent, what it actually ultimately sells for. Okay? Everybody cool with that?
Overinflation or inflated net operating income to deferred maintenance expenses.
Right.
Slumlord, right. I see where you're going. I see where you're
Okay. All right. Anybody else? Other questions? Okay. We got, it's about 9:15. Okay, I think you're well, one more little topic before I forget. Just terminology. I just forgot to mention this. What is a promote? A developer's promote.
Like an incentive?
What? An incentive? Did you say that, Premier?
Like acquisition,
Okay. Anybody else? Developer promote.
He shares in the profits.
Yeah, and so this kind of also gets into this, what we were just talking about, that in essence, that whenever we were talking about the deal structure, and we were talking about that, the distribution that the developer would receive, basically part of, if they're getting more than what their contribution is, like for example, let me make this very simple. If the developer is putting in 20% equity, but they are getting maybe 50% of the proceeds from the distribution of the before-tax cash flow and the sale, that amount above and beyond really the 20% is considered to be a promote. And what that means is just simply, it's meant to be viewed as, it's just a term. That's all. I'm not trying to make this more complicated. It's just simply saying, this is in essence, we're paying you this extra to promote the property and to promote its success, okay, is really what it boils down to.
is extra paid to the developer?
Right. So it's basically an incentive, okay?
Is it based on performance or?
Yeah, well, it's not necessarily based, well, it is, because in essence, as your before-tax cash flow gets higher, or as your basically reversion gets higher, you're making more money.
Okay, because you're shipping.
So in other words, maybe put the screen back up here for a second, so I can just kind of point it out on the screen.
So the incentive paid to the developer, is that because they meet on expectations?
Sharing, sharing profit.
Okay.
There we go. Okay, so in the sort of final example that we gave, in this particular example, okay, so this, okay, so this was pari passu, okay? Now, so in this case, the 20% the developer is receiving is strictly the pari passu distribution, okay? Now, anything that we give the developer beyond that is going to be considered to be promote. So if all of a sudden we change this to, let's say, 70-30, 10% would be the promote. Does that make sense? Okay, above and beyond what they're contributing. Okay, terminology-wise. All right. Okay, I think that's it. All right, so let's do this. We're gonna do a quiz, but we've got a bunch of stuff to do after the quiz, okay? So once you're done with the quiz, you know, hopefully we can get everybody done relatively soon and get back in here. And hopefully we can maybe open these doors, get the air fluctuating back in here as well. Yeah, I'm gonna do that. Okay, now, once again, the quiz is open book, open notes, open calculator, closed computer. Okay? Closed phone.
Are we gonna do that first, or are we taking a break first?
You can take a quick break. That's fine. No, if you need to go take a break, we'll go for it.
And I'm assuming, you're gonna give us an answer sheet as well?
Yep. You can put it right on here for now.
Ah.
I mean, quite frankly, what you should use is the blank version of what I gave you. Yes.
These two right there, put it in this.
Yep. So what you should, okay, what I gave you was the quiz sheet, which is one page back and front, 15 questions. And then one of the handouts that I gave you has a blank version that you can use as your formatting to fill out the quiz.
Are you allowed? I'm allowed.
Has it gotten quiet out there yet, or is it still noisy? The airflow in here.
So he just wants us to write on it?
You can use this.
It's too noisy, we can close it again.